Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing WiMi stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. WiMi is located in China. It uses holographic technology for home entertainment purposes, movie theaters, performing arts centers, commercial publishing, and advertising display systems. Let's get started with the model. This is a small cap company, market cap 406 million. They're trading at 608 a share, and they have 67 million shares outstanding. Let's look at the financials. The way you value a company is you forecast the free cash flows into the future, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the company does have positive free cash flow every year. Net income is a profit and loss on the income statement. It's revenue minus expenses. They also have positive net income each year. Revenue is a sales for the company, and that grows quite a bit from 29 million to 48 million. This is the company's income statement, and their financials are all in Chinese yuan, but my Excel file converts the numbers to US dollars. But if you want to look at any of these numbers in US dollars, just divide by 7. The top line of the income statement is the revenue. Below that is cost of revenue. They have nice gross profit each year. Below that is the operating expenses. And they do have pretty good operating income each year, over $100 million in 2019. They do have to pay interest on their debt and, of course, taxes. So the bottom line of the income statement looks pretty good, 73 million up to 100 million of net income. This is the statement of cash flows. The top line is operating cash flow. That's how much money the company generates from its operational business. That looks really good, 100 million to 145 million. Capital expenditures are investments in property, plant, and equipment, and that's pretty small for this company. So to calculate free cash flow, it's operating cash flow minus capex. So they have lots of free cash flow each year. The company issued 15 million of debt in 2018 and 88 million in 2019, but they paid down more debt than they issued, which is good. In 2018, the company issued $138 million of convertible preferred shares. When you want to invest in a business, you should make sure they have positive operating cash flow. And this company does $100 million to $144 million a year in operating cash flow. And the way you calculate operating cash flow, you take net income, and then you have to add or subtract the non-cash items from the income statement. They pass through a $14 million depreciation expense, so we have to add that back. They also passed through $11.5 million of non-cash items. And they had a positive $16 million in changes in working capital. This is changes in accounts payable, accounts receivable, inventory, things like that. So their financials look pretty good so far. Let's look at a capital structure. They have $63 million of equity, $13 million of debt, but they have negative $6 million of net debt. That means they have enough cash on their balance sheet to pay off all their debt and still have $6 million of cash left over. Their WACC is 13.8%, and that's a blend of the cost of equity and cost of debt. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for that 700 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $547 million. We divide that by 67 million shares. And we get a calculated stock price of $8.19. They're trading at 608, so they're trading at a 26% discount. It's a buy according to the model. Simply Wall Street values this stock at $24, so they're saying it's really undervalued. The stock began trading in the United States this year, so you can see it was pretty flat for a few months. Then it jumped way up in July up to over $20. And then it's come back down, so it's been sitting around $6, $7, $8 for several months. Back in June, I made a video on WiMi that the stock was worth $8.45 when it was trading at $3.40. At the time, that was the only video made about WiMi stock. When the stock shot up 300% overnight, that video got tons of hits. You can see my subscribers. It was flat, and then the WiMi video, it went way up. I still got subscribers the days following, but then it's come back down. It's interesting to see my model today is still pretty close to my price back in June. If you invested $10,000 into this company back in April when it IPO'd, you'd have $11,000 today. The stock has gone up 10.5% in the past 52 weeks, a little worse than the S&P, which has gone up 15%. And the stock's low was 320 and its high was 29.50. The stock is trading below its 50-day moving average and 200-day moving average, so it's on a downtrend. When the 200-day moving average crosses above the 50-day moving average, that's called a death cross. That's a bearish signal. The trading volume is pretty low for this stock, about 1 million shares per day are traded. And of the 67 million shares outstanding, only 11 million are on float. And very few institutions hold this stock, only 1.28% of the shares are held by them. And less than 1% of the shares are shorted. Their top shareholders are Vital Success at 23%, WiMi Jack Holdings 15%, then 13.5%, 11%, and 7.8%. Let's look at the financial ratios. The average PE in the market's 12.2, the median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 26.5. That means investors are paying $26.50 for $1 of earnings. Price to sales is stock price over sales per share. They're at 8.5, so they're a little worse than the average. Price to book is stock price over book value per share. They're at 6.4, also worse than the average. And to calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have 63 million of equity, 43 million of tangible equity. Interest coverage ratio is EBIT over interest expense. They're at 1.5, so they can just cover their interest payments. ROE is net income over equity. They're at 24%, so they have a really good ROE. Current ratio is current assets over current liabilities. They're at 1.5, so they can cover their current liabilities with their current assets. Current assets are 129 million of cash and 42 million of receivables. And the company does seem to be well capitalized. The free cash flow was 22 million and their working capital is 8 million. The best way to look at ratios is to compare them to similar companies. I've done videos on Interpublic Group and Omnicom, both in the same industry as WiMi. And if WiMi has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in all the price multiples. They're better in current ratio. They're the only company above 1. ROE, they're at the average. They have the lowest debt of all the companies. They're by far the smallest company of the bunch. So to summarize, the company does have decent financials. They seem to make really interesting and cool products. I know there's some concern with the Chinese government because they're really leaning into Alibaba, accusing them of being a monopoly. And that's causing people to shy away from other Chinese stocks. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.